On June 12, 2026, SpaceX went public. And for about 4 days, it felt like the greatest investment opportunity in a generation. The stock opened at $160, shot past $200, briefly hit $225, and every person with a brokerage account was either celebrating or watching with intense FOMO from the sidelines. Then, it fell hard. Back through $200, through $175, below the opening price, and by late June, it was trading around $150. Still above the $135 IPO price, but a long way from $225 in less than 2 weeks.
If you bought at $200, you were already down 25%. If you were sitting on the sidelines wondering whether $150 is a buying opportunity or a warning sign, you are not alone. And if you just want someone to give you an honest answer instead of either pure hype or pure doom, that is what this video is. I spend way too much time thinking about investing, valuations, and the gap between what makes a great company and what makes a great stock. Those are not the same thing. And with SpaceX right now, that distinction matters more than almost any stock I can think of. Subscribe and give this a thumbs up if you want the real breakdown. Let's go through it properly.
The single most important thing to understand before we talk about SpaceX as a stock is this. A great company and a great stock are two completely different things. SpaceX is almost certainly a great company. Whether it is a great stock at this price is a completely separate question, and one that most of the conversation around this IPO has aggressively avoided answering. Amazon was a great company in 1999. It was also a stock that fell 95% between 2000 and 2001 because the valuation had gotten completely disconnected from the underlying business reality. The company survived and eventually became one of the most valuable businesses in history. But if you bought it at the peak in 1999, you had to wait until 2009, 10 years, just to break even. Great company. Terrible entry point.
That is the question we are actually trying to answer today. Not whether SpaceX is impressive, it clearly is, but whether buying the stock at this price, right now, makes financial sense for a real person with real money. Let's start with what SpaceX actually is in 2026, because the company has changed significantly from the rocket company most people picture when they hear the name. SpaceX today is 3 businesses operating under one roof. The first is the launch business, Falcon 9 rockets, the most reliable and cost-effective launch vehicle in history, launching satellites, resupplying the ISS, dominating the commercial launch market in a way that no competitor currently comes close to matching a monopoly. A Falcon 9 booster just completed its 35th flight in June 2026, a record that would have been considered science fiction a decade ago.
The second business is Starlink, a constellation of over 9,800 satellites in low Earth orbit, providing high-speed internet to more than 10 million subscribers across more than 100 countries. Starlink is the revenue engine that funds everything else SpaceX does. It generates the cash that pays for Starship development, that covers the operating losses, that keeps the whole operation moving forward. The third business, and this is the newest and most speculative piece, is xAI. In February 2026, Elon Musk completed a merger between SpaceX and xAI, his artificial intelligence company, in a deal that valued the combined entity at $1.25 trillion.
SpaceX now has an AI division, operating data centers, signing massive compute deals, a $920 million per month deal with Google announced in June, and a $150 million per month deal with a startup called Reflection AI. The AI business adds a completely new dimension to what SpaceX is and what it could become.
So when you buy a share of SPCX, you are buying a piece of all 3 of these businesses simultaneously. The established rocket launch operation, the satellite internet business with 10 million subscribers, and a nascent AI infrastructure company with some very large contracts and very high ambitions. Now, let's talk about the numbers, because this is where it gets complicated. SpaceX generated $18.7 billion in revenue in 2025. That is real meaningful revenue. But the company also posted an operating loss of $4.2 billion and a net loss of $4.9 billion in the same year, which means that right now, SpaceX is spending significantly more money than it makes. Analysts do not expect SpaceX to be free cash flow positive until 2029. That is 3 more years of burning through cash before the business generates more than it spends.
At the IPO price of $135, SpaceX was valued at $1.77 trillion. At $150 today, it is worth approximately $1.97 trillion. To put that in context, you are paying roughly 106 times revenue for a company that is currently losing nearly $5 billion a year. The 9 largest public companies in America by market cap all generate tens of billions in profit annually. SpaceX generates billions in losses. The valuation is not based on what SpaceX is today. It is entirely based on what SpaceX could become, which is either the most exciting investment thesis in the public markets or an enormous amount of optimism priced into a stock that has very little margin for error.
Let's make the bull case properly, because it deserves to be made properly. The bull case for SpaceX starts with Starlink and the total addressable market it is going after. There are approximately 4 billion people in the world who still lack reliable internet access. Starlink is uniquely positioned to serve a significant portion of them in a way that ground-based internet infrastructure simply cannot. As the constellation expands and the cost of terminals continues to fall, the subscriber base could grow dramatically from its current 10 million. If Starlink gets to 50 million subscribers at a reasonable average revenue per user, the math starts to look very different from what it looks like today.
Then there is Starship. Starship is the rocket that changes the entire economics of space. It is fully reusable, designed to carry massive payloads, and if it reaches operational status at scale, it would make every other launch vehicle on the planet look expensive by comparison. A fully operational Starship fleet would slash the cost of putting satellites into orbit, potentially allow SpaceX to replace its own Starlink constellation with a new generation of cheaper satellites, and open up commercial opportunities in space that do not yet exist. Starship Flight 12 was partially successful in May. Flight 13 is expected around mid-July. If Starship reaches regular operational cadence in the next 12 to 18 months, it is genuinely transformative for the business. And then there is the AI angle. The compute deals SpaceX is signing are enormous. $920 million per month from Google alone.
If xAI becomes a meaningful AI infrastructure player alongside the space business, the revenue diversification could be significant. The intersection of satellite connectivity and AI infrastructure is a genuinely interesting space that no other company is positioned to occupy the way SpaceX is. If all of this works, Starlink scales to 50 million subscribers, Starship reaches operational status, xAI becomes a major AI infrastructure business, the $1.97 trillion valuation of today looks cheap in hindsight. That is the bull case, and it is a real one. Now, the bear case. And this is the part most of the coverage of this IPO has been reluctant to make clearly.
Start with Starlink's revenue per user trend, because this number deserves attention. In 2023, Starlink's average revenue per user was $99 per month. In Q1 2025, it was $86. In Q1 2026, it was $66. That is a 33% decline in average revenue per user over 3 years, while the subscriber base was growing, which tells you that Starlink is adding subscribers, but at lower price points, either through geographic expansion into lower income markets or through competitive pricing pressure, or both. A business where revenue per user is declining structurally while overall revenue grows is a business with a potential ceiling on profitability that the current valuation may not be accounting for.
Then there is the profitability timeline. SpaceX lost $4.9 billion in 2025, worse than the $791 million profit it posted in 2024. It is moving in the wrong direction on profitability in the year before its IPO. The
The company is also taking on $25 billion in debt to fund its growth ambitions. Free cash flow positive is not expected until 2029 at the earliest. 3 years of losses and debt accumulation before the business generates more than it spends at a $1.97 trillion valuation. Then there is Starship itself. Starship has been in development for years. Flight 12 in May was partially successful, meaning it was not fully successful. Flight 13 is coming, but the path from test flights to operational commercial launches at scale is long and uncertain. The rocket has to work reliably, affordably, and at high cadence for the bull case to materialize. None of those things are guaranteed.
And then there is the Musk Factor. Elon Musk controls 82% of the voting power in SpaceX after the IPO. That means as a retail investor, you have essentially no influence over how the company is run, who runs it, what strategic decisions it makes, or what happens to your money. There are also persistent rumors that Musk wants to eventually merge SpaceX with Tesla. If that happens, the terms of any such merger would be entirely within Musk's control to negotiate in a way that may or may not be favorable to SpaceX shareholders. Buying a stock where one person has 82% voting control and a history of making dramatic strategic decisions with or without shareholder input is a real and specific risk that most of the IPO coverage has understated.
So, who should actually buy this stock? If you are a long-term investor with a time horizon of 10 years or more, a high risk tolerance, and you genuinely believe that Starlink will scale to tens of millions of subscribers and Starship will reach operational status, SpaceX at $150 is a bet worth considering as a small portion of a diversified portfolio. You are paying for a future that may be extraordinary. The price reflects that future being probable rather than possible. If it plays out, you will likely be very glad you bought. If it does not, if Starship continues to face development delays, if Starlink's ARPU keeps declining, if the AI business does not materialize the way the compute deals suggest, $150 could look expensive for a long time.
If you are a short to medium-term investor who bought somewhere between $175 and $225 in the first week of trading, the honest answer is that you bought into pure post-IPO momentum at a valuation that the fundamentals do not yet support. That does not mean you are definitely wrong. Momentum can continue, and the business can grow into the valuation, but you should go in with clear eyes about what you are holding and why. If you are sitting on the sidelines at $150, wondering whether the pullback from $225 is a buying opportunity, it might be. But the more important question is not whether $150 is better than $222. It is whether $150 is a price that reflects fair value for a business losing $4.9 billion a year with no path to profitability until 2029. The answer to that question depends almost entirely on how much you believe in the bull case.
Here is the thing about SpaceX that makes it genuinely different from most IPOs. The downside scenario is that you own a piece of a company that continues to lose money for several years before either growing into its valuation or not. The upside scenario is that you own a piece of the company that builds the infrastructure for humanity's expansion into space and dominates AI infrastructure while doing it. The range of outcomes is genuinely wider than almost any other stock available to retail investors right now.
Wide outcome range means high risk and high potential reward simultaneously. That is not a reason to avoid it. It is a reason to size your position accordingly. SpaceX at 2 to 3% of a diversified portfolio is a reasonable speculative bet for a long-term investor who believes in the mission. SpaceX at 20% of your portfolio is a bet that could go very well or could set you back years financially, depending on how the next 3 to 5 years unfold. The company is extraordinary. The stock is priced for an extraordinary future that has not yet happened. Whether that future arrives on schedule is the only question that matters. And nobody, not the analysts, not the bankers who priced the IPO, not Elon Musk himself, knows the answer to that question right now.
What you do with that uncertainty is the actual investment decision.